It is random. There is no logic behind which five are going to be the best in the next 1 year. Thousands of years back, when hunter-gatherer tribes would move around, we would always move in tribes. We assume what we are seeing today will continue to happen. The birth of a cycle is when crowds rush in. Let the fund be what it is. Let me try to be a Q1 investor.
Hello, everyone. As we complete 9 years of Zvest this week, one truth stands out. Unless investors understand cyclicity, even the best portfolios will feel unstable. And this is the pattern we are determined to break. Every investor has seen the story play out. A fund does brilliantly, the rankings light up, social feeds celebrate it, and money rushes in right when the cycle is turning. Top quartile becomes the third quartile. Last year's heroes quietly slips down the list. Investors wonder what has changed. Today, we dig deeper than the headlines. We unpack the real mechanics behind cyclicity in mutual funds, why it happens, how investor behavior amplifies it, and why even smart investors get caught in the loop. To help us decode all of this, we are joined in by Mr. Kalpen Parekh, MD and CEO of DSP and Asset Managers Private Limited. With a rich experience of 27 years across asset classes, he is someone who has watched these cycles unfold from the closest seat possible. And with his deep passion for behavioral finance, we are certain this conversation is going to be a masterclass in performance cycles, investor psychology, and how to build portfolios that stay steady even when the rankings don't. Thank you, sir, for joining in and your time today.
Thank you, Megha and Harsh, for inviting me, and most importantly, congratulations for completing 9 years. Just realized when you spoke about it, and it is a very credible thing that Zvest and all of you are doing to help investors, to help consumers become better investors. Otherwise, it's easy in this type of a fast-moving market to acquire customers, but to acquire investors is a challenge. So, compliments to what you guys are doing.
So let's begin by addressing the most fundamental case in point, which is cyclicity. We understand that cyclicity as a term is almost synonymous with capital markets. We see it across geographies, sectors, styles, investor interest rate cycles, etc. And we also see it, as far as the fund returns are concerned. Can you help us understand what leads to the drift in cycles?
So this is a very important topic, and I've been grappling for 27 years. If one thing we need to learn not to do as investors, and why most investors earn poor outcomes, even though markets create wealth, is because one, we assume what we are seeing today will continue to happen. So if we are in good times right now, we extrapolate these good times for either a fund or an asset class, or wherever we are investing. And if we are in bad times right now, we extrapolate that again. And this is basically our human bias of extrapolating the recent presence or the recent present. And this technically is called recency bias. And we do make efforts to educate and explain about these concepts. I have struggled to explain in an interesting and simple way. Hopefully these questions might help us take one step closer. But the fact is that what happens is that when something starts doing well, there is this innate desire in human beings to participate in that in any part of life. It's not just investing. If some section of a city starts getting popular for real estate, then the crowds will go there. It is, I think, our inner behavior of wanting to belong. um, Thousands of years back, when hunter-gatherer tribes would move around, we would always move in tribes for sake of protection, because standing out would have meant some animal would have come and eaten you, and you would have been out of the gene pool, and we would not be talking. So the human race generally likes to belong, and it has worked for us. So wanting to belong is a very important part of life. The same thing we apply in investing. So whatever is happening, we go there in crowds, and when crowds move into an asset class, the asset class becomes crowded and becomes extremely expensive, and it deviates from what its core long-term returns are. And when we invest in something which is at a much higher return than its core long-term returns, in the next phase, it has to give up. Someone has to pay a price, and the price is paid by the one who's entering into a crowded lane. People in Bangalore obviously will relate to to crowded lanes because every lane is crowded and traffic takes longer. So, when we are driving, we want empty lanes, but in investing, we see crowded lanes. So, this desire to be where everyone is going because there is comfort. And the biggest comfort we draw as investors is that if last 1 year return is up 40%, I was very shocked and a bit, sad when few days back, one of my friend invested in one of our funds, which is up 60% in the last 1 year. And I asked that, how did you select this fund? What was the logic behind selecting this fund? And there was only one logic. And he said that uh, it is giving 60% return. He didn't even say it has given because it is in the past. Given is in the past, ho gaya hai. When he said it is giving 60%, it made me think, what is he thinking? So I asked him, it is giving ka matlab kya? Are you receiving that 61? He said, I'm sure I will because it is giving 61. So this mindset that whatever is our last 1 year, 3 year, 5 year return is likely to be our current return as we invest needs to be broken. And when we start putting more and more money to the existing popular asset class, is where cycles start getting born. The birth of a cycle is when crowds rush in, and the death of the cycle is when crowds move out, when crowds themselves die, and the cycle ends. So I think that is the background of why cycles exist. People go into an asset class in huge crowds. They put in a lot of money. Prices rise irrationally, and then something goes wrong because prices cannot keep rising irrationally forever. It is like trees growing to the sky, or it is like saying that that gravity does not exist on Earth and anything can keep rising forever. Because when something starts rising beyond its fair value, some smart money starts taking advantage of that. So markets are such where there are smart investors on one side who are waiting to exploit the not so smart investors who are waiting to get exploited, and the tug of war between these two camps creates cycles.
I think it's very important to understand that, investing is actually a zero-sum game. Fund houses like yourselves have been doing exceptional work in creating, this knowledge. However, we see that most DI investors, they try to find comfort or, try to invest in categories which have been performers in recent times. If I talk about September 2024, when market was at its peak, the categories which saw the highest inflows of close to about 13,000 crores used to be the sectoral or the thematic funds. This year, gold and silver has been the top performing categories and the flavor of the season, and that has also seen an inflow of close to about 16,500 crores. So these funds, as you rightly said, they stay hot till they aren't, and everyone who has probably been humbled by the markets knows that this is the worst possible investment strategy. But can you help us understand what cognitive biases, other than recency bias and platform features, should one be wary of so that it doesn't become a detriment in long term wealth creation?
See, the first thing is, whenever we go to play a game, we understand the rules of the game. We understand the boundary conditions of the game. We ask questions that क्या करने से हम आउट हो जाएंगे, हमारी विकेट गिर जाएगी, और बाउंड्री कहाँ पे है, उसके अंदर फोर है या सिक्स है. So I think it's very important in investing that we first ask what are the boundary conditions for this asset class. It means what has been its best return and worst return. And Most often, if we plot the rolling return of an asset class, let's take Nifty 500. If we plot annual rolling return, there is a year where it has earned 130% return because 1 year prior it had fallen by 60%. So it was just mean reverting. There are years where it falls 60% because 1 year prior it had gone up by 50-60%. Whereas the median return of Nifty 500 as an asset class is around 13 or 14% over the last 30 years, 14%. So if the median return is 14, but the 1 year is showing 130 and the lowest 1 year is showing minus 60, what is the truth? And that clarity, if an investor were to get, that which is the likely return I'm going to earn. 150 of last year is not yours. It is the guy who invested 1 year back when prior 1 year was negative. And when we plot this rolling return chart, it is such a beautiful chart which shows the valleys and the troughs. It does not show the 14% as straight line. It shows so many variations in returns. Now, the beauty about visually depicting returns is to really make someone understand that if you came in looking at 100, most likely you ended up earning much lower than 14 also. So I think the behavioral shift and change that one needs to do in terms of either reporting of returns, or in terms of, it's a lot of people may go to a website and search for returns. The first thing they do is best five funds. Now the industry has, let's say, 2,000 schemes today. At all points in time, 1995 schemes will not be the best, and any random five funds will be the best. It is random. There is no logic behind which five are going to be the best in the next 1 year or 3 years or 5 years. But instead of acknowledging that this is randomness, many people take it as extension, that okay, what is the best five today or as of yesterday will be the best five for tomorrow for my new money. And I think that needs to be highlighted or called out very effectively on all the websites, which are using returns to help investors take decisions. Because in that quest for speed, the best thing about investing using technology is it allows you to invest very quickly. It allows you to study and compare. But we want speed. We want to do everything in 1 minute. Now, in 1 minute, how do you explain all these things? It has taken me 7 minutes to still try and explain to you something which I've explained maybe only 1%. So it's not easy. And because it's not easy, there are cycles, and there are investors who will make money, and those will let them make money at the cost of them losing money. So I think if we start talking a lot more about likely returns, which comes through the concept of median returns, and highlight the setups which generate higher returns than median, the setups which generate lower return than median. And that is not difficult. So anyone who has studied investing would broadly know that if we have to invest for, let's say, 5 to 10 years, and if the current setup is very frothy, very expensive, valuations are out of whack, a lot of money is chasing an asset class, these are general signals that the asset class or the funds are getting crowded. Most likely future returns will be lower, and vice versa. Some categories are getting completely lonely or isolated, and no one is investing, people are taking money out, and because of which valuations have normalized. And the normalized means they are cheaper than what the intrinsic value of that sector or asset class is. Most likely in the next 5 years they will make more money. But there are a lot of nuances. It's not easy to explain in few minutes. But I think conversations like this hopefully will help investors spend more time on median returns, likely returns, setups which tell us the odds are higher or lower for the future. And everything is about probabilities and odds. There are times where a cycle gets extended for longer than what it has done in the past. So current returns extrapolation may work for you, temporarily may work for you, and give you wrong feedback that this is the way it is working, so let me continue to do that. But eventually when it breaks, it takes away a lot of returns and hurts your capital significantly.
I think it's important to understand that while data is great, but it can also be very delusional. So, and I think you made a very important point wherein you mentioned about we are borrowing returns from the future when we kind of get into a category which has been recently doing well. But the problem also lies in the way returns are kind of put in, because most platforms, so or where investors probably, as you said, go to the websites to search for the best returns, trailing returns in the last 1 year to 5 year period. They only focus as far as trailing returns are concerned. And that is a big limitation, as you rightly called it out. So, help us understand as to what happens, when a fund is actually moving from a Q1 category to a Q4 category, and how to understand whether it is a secular regime change in a fund's prospective returns or it is a temporary blip.
The second part I'll answer first. It is not, or it is almost impossible to know uh, pre facto that the shift from Q1 to Q2 is temporary, where Q2 will eventually become Q1, or is the shift a significant turning point? These are very difficult, views to make in advance, because this is a probabilistic field. Every fund manager, with all his intelligence and experience and skills, is trying hard to be the best. But mathematically only 25% of funds will win Q1. Mathematically, everyone wants to be there, but only 25 can be. Now which 25 will get there is very difficult to judge. And I'll tell you what I do. Hence, few things that I keep in mind. That one is to identify the right money managers. But how do you identify the right money managers? Because the only data that is easily available is again returns. So घूम फिर के we are saying returns से बच बच के जाना है, but बचने के लिए रिटर्न्स के थ्रू ही हम ढूंढते हैं उसको. So whichever way, it's a vicious circle that returns are guiding us for future returns. And hence we need to think of some qualitative dimensions also. And the qualitative dimensions are about knowing about the fund manager or knowing about the design of the fund. Most people don't talk about the design of the fund. What is the fund's mandate? The mandate is not about just large cap or mid cap or small cap or flexi cap. They are labels, they are categories. But within that, what is the approach with which the fund manager is going to manage? What is his ideology? What type of businesses he will always own and what he will never own? And every ideology does not work in reasonable periods of time. It works in reasonable period of time and it ends up making more money, versus when it doesn't work, it doesn't lose so much of money. And hence over cycles that ideology tends to do well. So I think I look for broadly what is the ideology, and not just in terms of virtue signaling. Everyone will say we buy quality companies, we respect valuation. That's very generic, but nuance it by asking or seeing the portfolio, that how are you thinking about value, how are you thinking about quality of the company, how do you understand turning points in the economy and the markets. There are turning points in profit pools. Very high quality companies of the last decades are getting disrupted with newer age businesses who are coming with very cutting edge ways of running businesses, creating network effects, creating millions of investors in a span of 3 4 years, but they are very expensive. So then these are the nuances that an investor has to learn, and it is not easy because you have your day job to do. Most people will not know the interplay of ROE growth and valuations. Most people will not be able to understand the concept of intrinsic value versus just valuation based investing. What is intrinsic value? What is discount to intrinsic value? So those are things one needs to read about, probe the fund manager, look up to his past interviews. What is the fund manager talking? Is he reasonably balanced in his opinions about his own fund? Is he at points in time also flagging off that maybe it is time that my fund may pause for some more time, because last few quarters have been extremely good and this cannot continue for too long. The fund manager also is at times nervous that okay, I can be very honest and transmit these things, but will an investor misinterpret or misunderstand and take money out unnecessarily? So there are a lot of these nuances, and hence almost impossible to solve what we are trying to solve. Your and our efforts are noble, but history is against us. You know, most people have not succeeded. We should keep trying. We recently did a marketing campaign which said, no more, no more being on average, no more chasing above average funds just because last 1 year has been good, no more just going to our website and searching for the top 5 funds. So there are a lot of these no more dimensions that we have spoken about. These are small attempts, and this has to be done continuously, consistently for many years. And some percentage of the investor community will start acknowledging that. But summarizing, look for understanding the design of the fund. Look for how is the fund being managed, whether it is automatically managed or managed by a portfolio manager. Look at its track record. Has it delivered in line with what it speaks about? And lastly, be very clear that no fund will remain in Q1 forever. It will migrate from Q1 to Q4 many times and back from Q4 to Q1. But I think the biggest learning that I have imbibed for myself is, let the fund be what it is. Let me try to be a Q1 investor. Am I a quartile one investor? Am I a five-star investor? Do I have the right method of sticking with a fund when actually it is in down cycle and about to turn around, versus chasing a fund which is in its peak cycle and can consolidate for the next few years? So I'll give you an example. We had a fund which was highly focused on only quality as a factor. Um, and factors keep rotating. So any fund which is a single factor fund will do very well when its factor is in favor, and will do very poorly when its factor is not in favor. So we had launched this fund when quality as a factor was underperforming. So in a way it was betting on mean reversion. So I had invested at early stages in the fund, and the fund did extremely well over the next 3 4 years. And then at that point in time, quality as a factor was at its all-time best. This fund was doing better than almost 1,000 other funds in the industry. It was in the top decile, and there was a time I had to buy a home, and it meant a very large payout. I did not take a loan because I'm not yet comfortable, having a loan. I needed capital, so I redeemed from this fund. I did what is very counterintuitive. I took away money from a fund which was at its best compared to its own peers or rest of the market, highest alpha, so on and so forth. Because the thesis was that the quality factor is getting stretched now. It is, delivering far higher returns than what its long-term median returns are. The valuations are crossing thresholds of one or two or two and a half standard deviation of most quality companies, and hence it made sense to reduce the exposure there. And one way of reducing was to use that capital for making another purchase. And that's how you think about it. On the other hand, there are times when, let's say, I have new money to invest. uh, what I look for is, I know I like these three fund managers in DSP, and each of them have something unique in their style. Who is underperforming right now is the first question I'll ask. I have already established that these are three guys who I like, or four guys I like. It means these are the four guys who generally have permanent class, but who is now having temporary form, which is bad form. And whoever is underperforming right now. Now, this is not a very scientific approach that it works 100% of time, but at least since 2008, when I have started taking this approach, almost 90% of times it has worked for me. So I feel my question always when I want to invest in DSP funds, that I would want to search for is, which is my not so best performing fund right now. So if I start asking better questions, my answers will be different.
You explained very beautifully as to how difficult, this entire process is. We thought stock selection is difficult, but we have also realized over the last 9 years that, fund manager selection is probably the only gospel of, kind of ensuring our investors are, kind of well positioned to get to where they wish to. So,
Let me interrupt before you ask me the next question on this. I was in a WhatsApp group of a lot of sincere investors, sincere professionals who are working hard to earn a living and then wanting to invest well so that they can compound their money and create better financial futures. And in that group, the type of questions that they were asking was so extremely basic, that you realize that the first thing they need to do is to look for a good distributor or an advisor rather than look for a good fund. Because in a maze of 2,500 funds which can go anywhere, how do you ensure that you're choosing the right fund? Now the struggle, so I used to respond back to query saying that your query is so basic. It means that you really need help. And I can't be the one helping you as a CEO of a manufacturing company, because I will have my bias for my own funds. I will never recommend to you fund which is outside of DSP. So you need a good distributor. So the next question was, how do I find a good distributor? Now that also is a challenge. There are more distributors than schemes. There are only 2,500 schemes, but there are, let's say, 25,000 distributors. So I think that's a big opportunity as well as a challenge. That if investors are able to get the right set of help, advice, guidance, but where do they make a start is an interesting topic for you to probably think of.
And I think the challenge is also, the way we look at it is, an investor should work with an advisor where he or she aligns with the most. Because if that doesn't match, this journey isn't for a few years, it's for decades, right? So,
True.
yeah. So, my next question to you is, probably from your own fund house, right? You would have, as you said, there are funds which don't do well, and you typically try to, kind of invest in those funds. So give us an example where one of your funds was struggling, it was unrated or maybe rated 4 or 5 or whatever, which has actually moved north. And what in the investment philosophy led to the outperformance? Was it active share? You DSP as a house focuses a lot on position sizing, which stage the business is in terms of the business potential. What were some of the things, parameters that actually worked for the fund? And also share with us an example where this approach of yours hasn't worked out the way it should have.
Yeah. So let's take our large cap fund. Now, the large cap funds typically across the industry, there is always this debate that large cap funds don't have alpha. And whenever debates become very popular, is when the debate is pro and wrong. So if you remember 3 years back, all narratives were large caps में alpha नहीं होता है, small और mid cap में alpha होता है. What transpired later in the next 3 years, large caps generated more alpha, as in more large cap funds generated alpha and less mid cap funds generated alpha. So these are again, things which keep mean reverting and changing. 3.5 years back, we also, evaluated that we were not doing a good job with our large cap fund over last 5 years, 7 years. It had not beaten benchmarks, and our reason to exist is to deliver better than the relevant benchmark on a reasonable period of 3 to 5 years. 1 year, 2 years can be too random. We upfront say that in 1 year, if we do very well, it is random. Don't give us any credit. If we do very badly, also, most likely it is bad luck, not necessarily bad skill. But measure us on a rolling 5 year basis. We should be able to deliver above benchmark returns. So our large cap fund was struggling, and most large cap funds in the industry were struggling. And one of the reasons when we analyzed was that when you own the benchmark and then reduce 2% management fees, mathematically, the odds of generating superior alpha comes down. And that's when we said, let's not, be very closer to the benchmark. Let's not hug the benchmark. We even released an ad saying that this fund manager doesn't like to hug the index. He likes to hug his family more than the index. And it was a way to convey the concept of active share. And the average active share in the fund industry is around 47%. This fund has around 70% of active shares. So it's a significant deviation from the Nifty 100, which is its benchmark. So that deviation was one input which we introduced, and this input was introduced basis obviously knowledge of cycles over the last 30-40 years in global fund management, our own analysis, and testing. You constantly do hypothesis testing that if we do this, will it work or not. And then apart from deviation, what was then important, so there are two conditions which are important. The fund has to deviate from benchmark to earn different than benchmark. Second, the difference should be positive. It could be negative also. The deviation could harm us also. So then you need skill and bit of luck, combination of both. That okay, if you are choosing only 20 stocks out of 100, it means 80 stocks can go faster than my portfolio and I'll be out of the game or I'll underperform the benchmark. So it's a risk, it's a career risk that the fund manager is taking. And that is one of the reason what we call institutional imperative. A lot of smart fund managers, well-meaning fund managers struggle sometimes because the institutional imperative by the organization, by distribution partners, by investors themselves is so strong to win every 100-meter race and eventually lose the marathon. But we took that call that there's no other way out. There's no other better way. We'll have to walk this path of volatile alpha. Highest alphas are always volatile. Now look at the paradox in investing. Most of us will search for consistency of alpha. Now consistency of alpha has to then cushion the alpha, because to get consistency you have to go closer to the benchmark. To earn higher alpha, you have to go away from the benchmark. When you go away from the benchmark, over cycles you earn alpha, but intermittently the alpha is very volatile. So last year the fund had 7% alpha. This year the fund has -1% alpha. Now here the fund manager plays a very authentic role every year when he's doing extremely well to communicate publicly that do not get carried away with my 1 year performance. This is my ideology. This is my approach. It will have volatility. We will underperform in between. Give us your 5 year money. Some people appreciate that and align accordingly. So this shift of high active share, and the other tweak we did was align the portfolio more to a valuation respecting strategy, and say that the portfolio will always have only those companies where implied expectations of growth from those stocks is low. What it means is these stocks are priced to reasonable pessimism or reasonability of outcomes. It is not priced to a lot of good things happening, because historically data says that a lot of good things generally never happen for too long. Goodness does not last for too long. Companies growing at 20% CAGR, there are hardly handful in the world, and beyond 5 years they don't grow at 20. That 20 comes down to 15 or 12. So don't have very high growth aspirations in the portfolio from a profit growth point of view, but wherever whatever estimates one has, they are valued reasonably. So these are two tweaks we made. And then 23, 24, 25, 3 years have gone, and the fund almost 80% of times has been in quartile 1 since then. 20% of times it is in quartile 3, which is the case right now. So right now it is, so after going through an upward migration for almost 8 plus 4, almost 12 quarters, it is going through marginal downward migration for 2 quarters or 3 quarters. Now the fund manager is always in doubt. Like you asked, he thinks that this is not permanent migration, this is temporary cyclical migration. But leaving that aside, like last week I redeemed some money from our gold mining fund, which is at a cycle high, to this fund, because I did not buy the fund manager's 3 year returns, which are doing very well, and he has been rated as a better manager in the last 10 years. What I bought was his ideology. I, as an investor, like an ideology where you buy companies which are cheaper than fair value. It's not necessarily this is the only ideology. There are growth ideologies also which make far superior returns. In this ideology, a fund manager like him may miss out the long terms of Amazons and Nvidia. He might get out of these stocks much early, or he may not get in at all. But he will also not lose big money when some of these big names correct very sharply. So this was one example where it improved its trajectory with partly some tweaks, and partly we didn't do anything in the existing portfolio. We said let mean reversion happen, because if we keep shifting, we will not let mean reversion happen. Um, on the other side, one of our very special precious fund, which is our DSP Mid Cap Fund, has been a marquee fund for us, a very important fund for us. One of our best money managers manages it with, and it's like his name is on the table. He's been managing it for now almost 15 years, and the fund has done extremely well. The fund manager was rated as the best fund manager on earth, I'm using the word, by Forbes some time back, when the last 5-year returns were 40% CAGR. He was that time managing the micro cap fund of DSP. Now, at that time, when he got this award, uh, the small and micro caps were flying, and 1 year return was some 100%. Last 4-year return was 40% CAGR. And he came to me and he said that this category is becoming extremely hot, and deploying new money into this hot category will not necessarily deliver great value. So let's close the fund. So this was in 2017. So we shut the fund sometime mid of 2017. The rally continued. The fund manager had become defensive. He started keeping some cash, not realigning the portfolio, did not participate in that full upcycle, and lost some bit of performance. Almost for 3 years, the fund remained shut. Where after 2017, the 2018 small cap crash happened. Again, it rose back, and 2020, the crash happened. And only later, 3 years later, we reopened the fund during COVID when valuations had come down. Likewise, the mid cap fund. So these were funds where, from a best performing fund on earth, the fund manager went through a cycle, not because he has an issue on skill, because he sticks to his ideology. So his what has worked for him in his, let's say, 18 years of managing this fund, what has worked for him for 14 years is not working in the last 3 years. Now the debate in his mind, and these are the dilemmas of a fund manager. Many times, we think that they care a lot more about delivering fund performance because it is their reputation on the block. So it hurts them more than you and me, that okay, I need to bring it back. The dilemmas are that, is my style now getting out of fashion for too long? Is my skill getting challenged? Am I being complacent? Or what has worked for me on first principles will eventually work for me. So let me not you know give up my ideology, what has really kept me in good stead. So the ideology that he follows is buying good companies and promoters. uh, and whenever that company is in an industry which is going through a cycle, see, every industry also slows down. So let's say the portfolio has a lot of healthcare stocks, or textile stocks, or specialty chemical stocks, and or auto ancillary, and they are going through a 1.5 year of slowdown in their sector. uh, this fund manager's belief is that in a bad time, own the best company and the best run company with the best promoters. They will turn around faster than the cycle itself and the sector itself. And when they turn around, the returns will make up significantly. It has worked till 2021 for him, or till 2022. 23 and 24, it did not work for him. Holding on to such companies for longer is not, the turnarounds are taking longer. Maybe the business models are not turning around faster in this cycle versus what happened. Could be a reality, or it is just a matter of time. And these are the dilemmas. So what does he do today? So let's say he has a portfolio turnover of 15% at large. So normally once in 6 years he gets out of a company. He likes to give time to the management and the company to deliver and create value. He does not like to churn. But from 15 years brought the turnover to around 30 at this point in time, because he's saying that okay, let me not be biased by my own past beliefs. If something has not worked for me third year in a row, let me reuse it. My core ideology will not change. I will still stick to high quality companies, but I'll do a little bit of more active management. If a stock runs up very quickly, I'm happy to take profits. Or if I've invested in something which is taking much longer, and the business model is taking longer, I will trim little bit weights and reallocate. So he's making that attempt, and hopefully the attempt along with the mean reversion of the product will make it from Q4 to Q3, Q2, Q1. So from Q1 it went down to Q4. Now it has moved to Q3. The turning point has started basis some of the changes that he has made, and we hope that these are durable now. And only time will tell. We believe they are durable, but only time will tell. And in all honesty, I'm highlighting that some of these things are too difficult to forecast or preempt. We can only hope and give our best to outcomes.
Understood, sir. And I think that was very detailed response, and it would help us a lot in terms of our analysis of the funds also. So my next question is about investor behavior being amplified by the different stakeholders in the chain. And let me just give you an example. We have seen fund houses coming out with NFOs when the category would have done for well for 6 months or 1 year. We have seen advisors recommending those funds basis the recency bias they would have about the returns or the perception of a category to continue generating return for a longer period of time. And so is the case with DIY platforms also. Now, there are two questions I have. Uh, whose responsibility is it to, come out of this loop and say, no, this is not correct and we should stop it? And secondly, how would an investor be able to judge whether his or her money is being invested with the right fund house in the right category or with the right advisor? Because, the other side could be playing momentum and this guy could be believing that they are playing long term.
So you're asking very tough questions, Harsh. Um, See, even momentum as a strategy has made money for very long periods of time globally. So we wonder at times that just because we don't participate in momentum or capture the momentum or don't deploy momentum in our fund management, does it mean that the factor is a wrong factor? The momentum was, if you see studies globally, and even I don't know, what is the fundamental reason, but it has shown to deliver superior returns for long periods of time. It is a very important factor not to completely ignore. So till it lasts, there is no way you can question what is continuously delivering. But I think there has to be better balance in deciding how do you introduce products, because end of the day it is your hard-earned money, or our investors' hard-earned money. So this is one tweak we have made in our product launch strategy or product focus strategy is whenever we launch a fund, the starting point has to be generally a down cycle. It means the past returns of that fund, or if that fund had been existing, the recent past returns would have been mediocre. It also means our collections will be moderate or below average. It also means we may not become very large very soon. And it also means, let's say, advisors or distributors may say that, okay, this fund is taking longer to grow, someone else is growing faster. So, the world respects speed. We have been taught to respect speed, size. So, unfortunately or fortunately, what we worship is what is going to create outcomes in the future. So if the worship parameter is size at times, then we don't have a choice. But what we have tried to do is launch funds in low cycle. um, Either we are investing our own AMC's money in that scheme, even if it's an NFO, or we are a family owned professionally run asset management company. Many of our NFOs are family which owns the AMC. 95% of their listed investments are all in our funds. Part of that 95 then comes into that NFO. So either the AMC is investing its treasury money in certain products, or the family is investing its money, or also people like me and the team, operating management team, we are putting our money. We hesitate to launch a fund where we believe we can't put our own money. That's the first thing. Second, there are times you want to launch an interesting theme, a new idea, and it's a good idea for the medium to long term. The temporary short term, the current short term may not be the best time. Like, I give a real life example. We launched a very interesting first of its kind index fund in India called the FlexiCap Quality 30 Index Fund. So it is an index which will be very flexible on market caps. Most indices are hard coded on market cap. This index will be flexible. So it will have two-thirds in large caps or two-thirds in mid and small cap, depending on how the cycle is, which means really flexible. So if an investor wants to invest for the next 10, 20 years, this fund will navigate you in terms of your market cap shifts automatically. Every, 6 months, this is a framework. The rebalancing between large cap to non-large cap happens. And the ratio is only one ratio, to keep it simple: two-third, one-third. Either of them will have two-third, depending on what is more attractive, basis the price momentum. So we don't have momentum factor funds as a fund house, but we are now learning to apply one slice of momentum factor only to do market cap selection. But once the market cap selection is done, the underlying goes back to first principles of high quality companies, which is where quality 30. Now, when we launched this fund 3 months back, we still realize that quality stocks are in a phase of underperformance. They have had a massive 2 year underperformance after a 10-year outperformance. It is likely that they may continue to underperform for some more time. The momentum factor was indicating that the portfolio will have two-thirds in mid and small cap, which is contrary to our current judgment that mid and small caps are frothy right now. So on one hand, our Netra is saying mid and small cap is frothy. On the other hand, we are introducing an NFO where two-thirds of the portfolio is in small and mid cap. Are we being inauthentic? We don't want to be inauthentic. So what we did is we launched the NFO as only an SIP NFO. So when you do an SIP NFO, the money comes in every month. So today's valuation becomes irrelevant. So an investor is investing for the next 10 years and 120 installments. Only 12 installments, only 10% installments will go in at today's valuation. And most likely, quality as a factor is anyways gradually drifting down and consolidating. So the investor will buy more and more units in a factor which is slowing down. So you are acquiring more when the factor is in a low cycle. So that's one way in which NFOs can still be done, and we try to do that. The second point is, how does a customer choose all these nuances? As I said before to Mega, I think a lot of work has to be done on helping investors choose the right distributors and making them realize that if you cannot do some of these nuances, if you cannot understand or learn these nuances, better to accept and look for an advisor. There are certain things for which you may not need an advisor. If you say that in your life you're going to be happy with one or two index funds and be very long term as an investor, you don't need behavioral intervention. Your behavior is far more mature. You have seen cycles. You don't need any one of us. Go ahead, quietly buy two index funds and give your money. But if you want to take few steps extra, you want to earn extra through choice of fund managers. But how to choose a fund manager, how to time his style, all of that research needs a good advisor or distributor. So more work needs to be done. I think real education is educating people on these type of dimensions, right? Either through writing or advertising or social media or discussions like what we are having today. But I think the responsibility of good outcomes rests with all three partners in this journey. It starts from us primarily because we are the ones who are so-called more experts. We say that we know more. Then comes you and the distributor, because you are equally in the game for the last many decades. The investor partly less, because the investor is a good doctor, he's a good coder, he's a good engineer, he's a good father or mother, but he doesn't have the qualifications yet to be a good investor till he comes up the curve. So I think the responsibility starts from us, then to you, and then to the investor.
Very well explained, I think, and we would strive to live up to that responsibility. So now, sir, I'll explain you how we design the portfolios. So generally, we keep the portfolios as core and satellite, where depending on your profile, your risk appetite, your goals, your efficient frontier, we design what should be the core of the portfolio. And in satellite bucket, we generally keep some percentage of those funds which have been out of flavor. Just to give you an example, in 2021, we started doing gold fund. In 2022, we did emerging market. 2023, we did private banking or banking and financial services in India. Now, there are two aspects to this. One, when this plays out as per what we would have thought, it plays out really well and investors are rewarded with the return. The second aspect is when it drags on for a very long period of time and doesn't generate returns the way investors would have thought or we would have thought, it really becomes a pain point for investors, and it becomes continuous coaching at our end, saying the same thing again and again. And sometimes even investors tell us that, you said the same thing 2 quarters back or 3 quarters back, and you're repeating the same thing. When will the cycle turn? So, as per you, A, is this the right strategy? And B, what are the positives and negatives of this?
See, there is no right or wrong strategy. The right strategy is the one which allows you to stay invested for very long. Morgan Housel's saying, I repeat in all podcasts, that that I look for reasonable returns for unreasonable periods of time. Most often, we search for unreasonable periods in unreasonably short periods of time. The quest has to be to have an investment approach or a portfolio strategy which allows me to stay invested for decades. Because if I stay invested for decades, even if I earn 1% lower return in the formula of compounding, the variable time has much higher weightage because it is next to exponential. So mathematically, it has bigger influence. Mathematically, it has bigger influence on on the final outcome. In that formula of amount equal to principal 1 plus r by 100 raised to power of t. Power of t has the maximum impact. So it means first I have to stay invested. I have to last the journey. So if I have a portfolio which deviates too sharply, which fluctuates too sharply, to throw me out of the train too early, and I don't reach my destination, it's okay to reach your destination slightly late or slightly early, but reach. But in many portfolio designs are not designed for longevity. They are designed for near-term assessments and near-term gratification. And the shift between near-term gratification to longevity has these type of reality challenges where even a well-meaning shift may take time to play out. See, investing is a craft or a game where the feedback loop on one hand is daily because every day NAV is published, but whether you are doing the right way or not is delayed. The right feedback loop comes 5 years down out. ये strategy सही था या नहीं था. Take credit funds for example. In 2015, 16, 17, every day the market was voting positively saying credit funds are great because हर दिन NAV ऊपर जा रहा है. Real time validation was happening. But it was also risk building up because all the NAV rise was because of the risk being taken, which eventually had to show up, and the risk was back ended. It is in 2018 one said that credit funds are bad or they are not well managed or whatever. But it was the seeds were sown in 2014, 15, 16 of greed and you know uh, of short term validation. One month return is higher than liquid fund, 1 year return is closer to equity fund, so on and so forth. So what happens is, this is again the tough part, that whatever we say ideologically and takes time to deliver, investor has to buy in that ideology upfront. It is very difficult when things are not matching what we have said. At that time, anyways, you and I are on the back foot. So today, if two of my funds are not doing well, whatever I say will have very limited credibility. And if two of my funds are doing very well, whatever I say which is irrelevant will also have very high credibility, which is the unfortunate design where outcomes determine whether what you're saying is right or wrong. Near-term outcomes determine the validation of your belief systems. So I think the only way to solve for this is to preempt and upfront lay out two, three choices in front of the investors and say, path A has this journey, this trade-off. Path B has different journey, this trade-off, and path C has this journey, a different trade-off. Now you choose or you decide what seems right to you. It becomes very important to involve the investors' behavior also. See, sometimes what happens is we assume that the opposite investor's DNA is same as mine. And whatever is my behavior should be his behavior because I'm a role model. I feel my behavior is the best behavior. Not necessarily. Yesterday, in one of our document, we have shown the rolling returns and the median returns of multiple categories or indices. Large cap, mid cap, small cap, gold, silver, so on and so forth, through a concept called violin graph. This is the first time my team has made it. I didn't know about this concept. So it shows the return ranges in the format of a violin, and the breadth of the violin will decide how often that range of return is likely to get. The length of the violin will determine the range of volatility. It takes you 10 minutes to look at that visually and get a lot of inferences. Now, if I am talking to an investor for the first time who says, I have money, I want to invest, and if I'm able to show the violin graph for different asset classes, so it very beautifully showed that the violin for silver, for example, is the longest. It has very high drawdowns and it is thinnest. It is thin. It also means that some of the good ranges of returns that we want over a long period of time, ideally they should be wider and not thinner. I think a lot of work can be done in visually conveying our opinions and paths. See, what we are trying to do is to talk about the paths of the future, which can be multiple, but talking does not absorb completely. So if we can visually make investors understand what are the likely paths, and when there are multiple paths, there are only probabilities that I believe as your advisor that path A is more likely to happen, but it may so happen path B will happen. So you decide which path you are comfortable with, and if path A does not happen, will you stay invested? If the answer is yes, let's choose the path you are comfortable with.
That was very important learning on how we should strive to visually represent things. And second thing was on how to take buy-in of the investors also while we are constructing the portfolio. So with this, we are toward the end of our conversation, and I would have a few rapid fires, and I'll just start the first one. which category, depending on valuation and other factors at this point of time, looks most at risk of cyclicity, and which is the one which looks most resilient?
So today, my portfolio currently, if I show you my current portfolio, the largest weight is hybrid funds because valuations are high and because growth rates of profit pools are moderate. Our growth rates are moderating at higher valuations. My bias is for hybrid funds. I have a very simple three-line investment philosophy: very expensive markets, hybrid funds and arbitrage funds; fairly valued markets, hybrid funds and equity funds; cheap markets, equity funds, risky funds, small cap funds, thematic funds which are in low cycle. You can, then accordingly calibrate. It's a very crude philosophy. It seems to have worked so far in the last 7, 8 years. Which category is right now extremely popular? As Mega mentioned, largest flows are going to gold and silver because of recent turbulence in central bank actions and discomfort on how on which currency will remain relevant or not. But a lot of these things were best to think about 4 years back when gold and silver were very cheap. We are proud to say we launched our silver fund 3 years back, and 3 weeks back, we actually communicated that gold and silver prices are now coming closer to what their fair value could be. It's a dichotomy, what I'm saying. To find fair value for gold and silver is not easy because they don't have cash flow, but we've still tried to do some framework creation to say that, how far or close is it. And as of today, gold's long-term return versus equity is at its highest gap ever. So that's a signal that the returns are very much higher than its long-term average. More people are chasing it. Every second tweet is about gold and silver. New funds are getting launched. So while we are believers that any portfolio should have 10% in gold, particularly if we are in an emerging market, we've also done one study which shows that 25 out of 25 emerging markets, gold has done better than their local currency equity return, more than their equity markets in their local currency. This ratio was 24 out of 25 till last year. India was the only market where Nifty had 1% higher than gold. As of today, that number also has flipped. So 25 out of 25 are. Now, this is very unusual that in 25 countries of the world, which have great companies belonging to different parts of the world, these companies are not able to beat a precious metal. But that is because the precious metal is now closer to its highs. So keep gold in portfolio through multi-asset funds or through a calibrated exposure, but don't go overboard just because last 1 year returns are good and because all of us are launching new funds. Relaunching new funds should not be your decision to add a fund in your portfolio. It should be only, it is like, pharma company launching 10 new medicines. We don't wake up in the morning to say, chalo, let's take all 10 because 10 rupees available hai. It has to be only if you need that medicine. So I think my bias would be that continue with hybrid funds at this point in time, hybrid and multi-asset funds, and be a bit more cautious about gold, silver. Yeah, that's how. And I can go wrong, because I may be still early, and the cycle of gold and silver, maybe it is a beginning after multi decades of going nowhere. These things will be known only in hindsight. But my bias is if an asset class is becoming, see, it's also relative then, that if gold silver is rising but if equity is now consolidating, then relatively I will prefer to come to equity. But if gold silver is also rising, equity is also rising, none of them are relatively cheap, then I would say still there is merit in having both of them meaningfully because both are expensive. महंगाई खरीदना है तो ऐसा एसेट क्लास खरीदो जिसका कोई नया सप्लाई नहीं है. But right now, gradually, equity is becoming, it's moderating. It's still expensive, but moderating.
Got it, sir. And so, as fund houses, there are various formats, various data points which are reported. Some are mandatory, some are optional. So, if there is one thing which you could change on what should be additionally displayed by the fund house, which they are at the moment not doing, what should it be?
Yeah, I think if we highlight this whole violent chart that I mentioned, that what are the lowest returns ever? If your time horizon is 3 years, what could have been your worst returns? And I'll give an example. One of my aunts, she must be 80 years old. After my uncle passed away, she got some money from fixed deposits, and then she said, "I want to invest in equities or equity funds." And why equity funds at 80 years? Is because at that point in time markets were doing very well and everyone is talking about equities. Of course, her time horizon is still very long term because the money will go to the next generation. But when I used the chart to show that, okay, I can give you this equity fund, Debt will give you a straight line 7% return, most likely. Equity can give you 10 to 12% return over a long period of time, but intermittently it can drop by 20%. 20% of times equity returns have been less than zero if you have a 3-year holding period. So we have a tool where I can press few buttons and it can show rolling returns for any time horizon. It can show rolling worst return for any time horizon. So when I showed that there is a chance equity can give this type of return, are you comfortable if it happens that way? And her answer was no, out of question. This is money accumulated over 80 years. Not a single rupee should be under volatility. So then the choice of fund, even though the time horizon could be 20 years for that money, but the choice of fund had to become a conservative fund. I think explaining using lowest returns and median returns is a great value add we would go to our investors.
In your experience, what moves first, flows or market fundamentals?
I didn't get that. What moves first?
Yes.
I think I don't have a scientific answer. I've not tested it with a formula. So whatever I say will be a Hawa ka answer. I think both have some overlap. There are periods when, fundamentals start moving and then flows start coming in. There are periods when returns start rising very sharply, out of sync with fundamentals, then flow start chasing it. So both the answers that I would give could be true at different points in time.
Got it, sir. And lastly, if you may please complete the sentence. In investing, cycles don't destroy wealth. This does. So what would be this?
Chasing past returns.
So with this, we come to the end of our conversation, and what an enlightening conversation it has been. I have jotted down a few points, which I'll just try to summarize in next 1 minute or so. So to start with, you mentioned how we humans, because of our history, have loved to be in tribes, and there is a reason for that, and it proved to be beneficial for us at that point of time. But now maybe it is not proving to be that beneficial. Second, you gave a very relevant example for our investors in Bangalore that in driving, we want empty lanes, but in investing, we prefer crowded lanes. Then you mentioned about how cycles are born, that birth of a cycle is when crowd enters and death of a cycle is when crowd leaves. And you also mentioned very beautifully about smart investors and not so smart investors, that smart investors are always waiting to exploit another set of investors who are not so smart and who are waiting to be exploited. Then we discussed about how we should select the fund manager, and you said that don't look at just the recent returns, but look at ideology of the fund manager, design of the fund, how the fund manager has been consistent with what he or she has been saying over a longer period of time. Look at the past interviews, and then try to infer who's the right person to be taken a bet on. Then very humbly you accepted that no fund is ever going to be in quartile one. So if a fund manager or a fund house is saying that invest with us, we will always be in quartile one, I think they are fooling themselves and the others. Then very important statement is not just about funds, but about investors. And maybe my fund would be quartile two or quartile three, but as an investor, I should strive to be Q1 investor. Very powerful. Then you mentioned about how alphas are created, and higher alphas are always going to be volatile because you're not going to hug the benchmark. Then a philosophical aspect from you in terms of goodness, doesn't last for too long, and so is the bad times. And lastly, about how we should involve investors in the decision making, because investors' DNA could be different from a product manufacturer or an advisor DNA. And one thing which would stay with us and we would try to implement is that we should use a lot more visuals in terms of explaining the concepts to the investors, because just saying things or just showing numbers in terms of returns and all at time may not stay with the investors, but visuals do stay. And to end, you mentioned about NFOs and how you correlated it with pharmaceutical companies, that if a pharma company is launching 10 medicines in a day, would you end up consuming those? And to end the statement or to end the podcast, the statement which you took from Morgan Housel, and I would again borrow from you, and I would end the podcast with that as an investor, I look for reasonable returns over unreasonable period of time and not the other way around. With this, we end our conversation. Thank you so much for taking out time on a Monday morning from your busy schedule and answering all our questions, not just for the heck of answering, but you answered in very detailed way by a lot of examples. And I think a lot of these things are going to stay with our investors. Thank you so much.
Thank you, Harsh. Thank you, Mega. I just want to compliment. I think I keep reading your LinkedIn posts. and they are very anecdotal in terms of a lot of life examples which you are relating it with some of these concepts of behavior. So just keep doing that. It's I think a very good direction to take, and I hope your investors and our investors benefit from that. And thanks for inviting me once again.